Yo, what's up everyone? It's TCV here. If you're looking at your portfolio lately and wondering what in the world is going on, you're not alone. The stock market's been doing this weird dance lately. 2 steps forward, 3 steps back, and frankly, it's got a lot of people stressed. The big question everyone's asking, should you be freaking out, or is this a golden opportunity to buy the dip? Look, I get it. Seeing red in your portfolio can feel like watching your money go up in smoke. But before you panic sell everything and stash your cash under the mattress, let's break down exactly what's driving this market downturn, and more importantly, how you should be thinking about it. First up, we gotta talk about the elephant in the room, or should I say, the donkey and the elephant. It's election season, and you can feel the tension in the air. It's an election year, and that always throws a wrench into the market's gears. The stock market becomes a roller coaster, with investors reacting to every poll and debate. See, whenever there's a major election, businesses and investors get this case of the wait and sees. They become hyper-aware of every political move, waiting for clues about the future. They hit the pause button on big decisions, holding their breath to see what policies the new administration or Congress might roll out. This cautious approach can be seen across boardrooms and trading floors. Think about it. Tax reforms, trade deals, and healthcare overhauls. These are all huge factors that can impact a company's bottom line. The stakes are incredibly high. These policy changes can either make or break a business, influencing everything from operational costs to market opportunities. And when businesses are uncertain about the future, they tend to play it safe, putting off investments and hiring, which can slow down economic growth. This cautious stance can ripple through the economy. This uncertainty trickles down to the stock market. Volatility becomes the norm as investors react to every piece of news. Investors, unsure about the future policy landscape, become more risk-averse. They start to question their strategies, often opting for safer bets until the political dust settles. Alright, next up, let's talk about the role of foreign institutional investors, or FIIs, in this whole market roller coaster. These investors are crucial players in the global financial ecosystem, and their actions can significantly impact market dynamics. These guys are like the whales of the investing world. They're huge players with massive amounts of capital, often running into billions of dollars. Their investment decisions can sway market trends and influence the behavior of other investors. And when they make a move, the entire market feels the ripple effect. It's like dropping a stone in a pond. The ripples spread far and wide, affecting various sectors and economies. Now, lately, FIIs have been pulling money out of emerging markets, and that's putting downward pressure on stocks globally. This exodus is causing significant concern among investors and policymakers alike. Why are they heading for the exits? Well, a big reason is rising interest rates in developed countries, particularly in the United States. Higher interest rates make investments in these countries more attractive. When interest rates go up in the United States, it makes U.S. bonds, which are considered a safer investment, more attractive to these global investors. The allure of a stable and secure return becomes hard to resist. Think of it like this. Would you rather risk your money in a potentially volatile emerging market, where political and economic instability can affect returns? Or would you rather park it in a safe, stable U.S. bond that's now offering a better return? The choice seems obvious for many investors. For many FIIs, the answer is a no-brainer. They prefer the security and predictability of U.S. bonds over the uncertainties of emerging markets. They're moving their money to where they can get the best returns with the least risk. This shift in capital flows is a strategic move to maximize profits while minimizing exposure to risk. And unfortunately, that means pulling out of emerging markets, which can lead to a decline in stock prices in those regions. This trend can have long-term implications for the economic growth and stability of these markets. Alright, next up on our Market Mayhem hit list, global instability. And let's be real folks, the world's been going through it lately. We've got the ongoing war in Ukraine, which has sent shockwaves through energy markets and global supply chains. Then there are the rising tensions with China, trade wars, political unrest. It's enough to make anyone want to bury their savings in the backyard. Here's the deal. Uncertainty and instability are the kryptonite of the stock market. Investors hate not knowing what's coming next. When you have geopolitical conflicts, trade disputes, or any kind of global turmoil, it creates this massive cloud of uncertainty that hangs over everything. Businesses become hesitant to invest and expand because they don't know how these events will play out. Now, let's talk about everyone's least favorite topic, inflation. It's that invisible force that seems to make everything more expensive, from your morning coffee to your monthly rent. Remember those carefree days when a gallon of milk didn't cost an arm and a leg? Yeah, me neither. Prices have been climbing steadily, making it harder for everyone to keep up. Inflation's been running hotter than a jalapeno on a summer day, and central banks around the world are scrambling to get it under control. They're in a race against time to stabilize the economy. Their main weapon of choice? You guessed it, interest rate hikes. By increasing these rates, they hope to make borrowing more expensive. By raising interest rates, central banks are trying to cool down the economy and slow down inflation. It's a delicate balancing act that requires precision and timing. The idea is that higher borrowing costs will discourage people from taking out loans, buying houses, or racking up credit card debt. This reduction in spending should, in theory, help to ease inflationary pressures. This slowdown in spending, in theory, should help bring inflation back down to a more normal level, but it's not without its downsides. But here's the catch-22. While raising interest rates might be necessary to combat inflation, it also acts like a brake on economic growth. This can lead to slower job creation and reduced economic activity, making it a tough pill to swallow for many. Okay, here's the thing about the stock market. At the end of the day, it all boils down to earnings. How much profit are companies making? That's what drives stock prices up or down. And unfortunately lately, corporate earnings haven't exactly been breaking any records. In fact, many companies are struggling to meet their earnings targets, and that's putting downward pressure on stock prices. There are a few culprits at play here. First, inflation is eating into corporate profits. Companies are facing higher costs for everything from raw materials to labor, and they're having a hard time passing those costs on to consumers, who are already feeling the pinch in their wallets. Second, those rising interest rates we talked about, yeah, they're starting to bite into corporate profits as well. So, we've covered a lot of ground here, and you're probably wondering, okay TCV, what does all of this mean for me? Should I be investing in this market, or should I run for the hills? Here's the deal. There's no one-size-fits-all answer. It all depends on your individual circumstances, your risk tolerance, and your investment timeline. But I will say this, if you're a long-term investor, and you should be, then downturns like this can actually be a good thing. Think about it this way. When the market drops, it's like everything's on sale. You have the opportunity to buy great companies at a discounted price. It's like walking into your favorite store and finding everything 50% off. Would you be freaking out, or would you be filling up your shopping cart? Look, navigating the stock market can feel like riding a roller coaster sometimes. There are going to be ups, downs, and moments where you just want to close your eyes and hold on tight. But remember, investing is a marathon, not a sprint. The key is to stay informed, stay disciplined, and stick to your long-term plan. Don't get caught up in the day-to-day noise or let fear dictate your decisions. Instead, focus on what you can control: your savings rate, your investment strategy, and your long-term goals. Remember, the market has a long history of rewarding patient investors who stay the course. So buckle up, enjoy the ride, and keep your eyes on the prize.